Setting up a family office in Dubai can be exciting, but many families make simple mistakes that cost them time, money, and peace of mind. In this video, I'll show you the 7 most common mistakes people make when starting a DIFC family office, and more importantly, how to avoid them. You will learn how to keep your structure compliant, protect your assets, and make sure your family office actually works for your goals. Before we start, my name is Shiraz Wahid and I'm the co-founder at Leopardus Wealth, where we have helped many of our clients and families with trust, foundation, and other asset protection strategies in Dubai. If you would like my help in doing the same, you can apply for a free and customized asset protection plan by clicking the link in the description below. Many people come to Dubai with a vision for their family office: asset protection, global banking, tax optimization, or smooth succession planning. But beneath the surface, the real success of a DIFC family office depends on careful attention to detail and anticipating what can go wrong. Some of the most experienced business owners and professional families still fall into the classic trap simply because Dubai's regulatory framework is different from what they're used to. The good news is that these mistakes are entirely avoidable if you know where to look. So, one of the first mistakes I see people make is rushing the process without a clear strategic plan. It's easy to be tempted by fast track setup promises that you see advertised. Dubai is famous for its efficiency, and it's true that DIFC can approve a family office in matter of weeks. But speed should never come at the expense of clarity. Setting up a family office is fundamentally different from opening a company. The foundation, governance, and operating model must all align with your family's unique needs, long term objectives, and global structure. If you treat this process as a box ticking exercise, just filling forms and submitting documents, you're likely to miss the key structural decisions that will affect the future. This includes choosing the right type of legal entity, defining the office purpose, and mapping out family governance roles from the start. The result of a rushed approach is usually a family office that lacks coherence, create internal disputes, or doesn't actually deliver the protection or tax benefits that you expected. The second mistake is underestimating regulatory compliance and reporting requirements in the DIFC. Dubai is not a secrecy jurisdiction. In fact, the DIFC prides itself on global best practice and regulatory transparency. Families sometimes assume that because DIFC is outside the onshore legal system, compliance is more relaxed. Well, that is simply not true. Every family office in DIFC must meet strict KYC, that is, know your customer requirements, annual reporting, and often must engage with DFSA, that is, Dubai Financial Services Authority. If you overlook these obligations or leave compliance matters to the last minute, you risk fines, loss of good standing, or even a public record of non compliance. This also extends to accounting standards. The DIFC uses IFRS, that is, International Financial Reporting Standards, not the local or informal bookkeeping. Make sure your family office has a professional compliance officer or a trusted third party advisor who understand these details. If your office is structured for true longevity, every detail must meet both local and international standards. Another mistake is failing to optimize the banking and operational structure from day one. Many families focus so much on getting the family office licensed that they forget about practical banking. Opening a corporate account in Dubai, especially for a newly formed family office, is not always straightforward. Banks will require complete understanding of the family office activities, ownership, and source of wealth. If you neglect to plan your banking relationships or cannot clearly explain your office structure, your account opening can be delayed for months, or in some cases, rejected altogether. The best approach is to prepare your banking file alongside your DIFC application with all documentation ready to satisfy both the DIFC registrar and your preferred banking partner. It's also wise to structure the office in a way that accommodates both local and international banking. Some families, for example, create a holding foundation in the DIFC and then set up special purpose vehicle, that is SPV, for different asset classes. each with its own operational account. Thinking through this structure early on not only saves time but also increase your options for global cash flow and investments. The fourth common mistake when setting up a family office is overlooking family governance and succession planning. A family office is not just an investment vehicle, it's the engine of long term family unity. In Dubai, the regulatory framework gives you significant flexibility to define how decisions are made, who is involved, and what happens in the event of disputes or generational transitions. Many families, however, leave these matters vague or postpone them until a crisis emerges. This can lead to uncertainty, family disagreements, and even litigation. The most robust family office uses the setup process to document clear governance protocols. How the family council operates, who has the voting rights, what happens if a key family member passes away, and how beneficiaries are added or removed over time. These governance documents are not just regulatory formalities, they are your family's rulebook for the next generation. Taking the time to design this framework at the start ensures that your family's intentions are honored and that family office will remain resilient even as your family grows or changes. The fifth mistake is failing to integrate tax and residency planning into your DIFC family office at the beginning. Dubai's tax environment is attractive, but tax compliance for international families is complex. Many families have members who are resident in multiple countries, each with its own laws, reporting obligations, and disclosure requirements. If you set up a family office in Dubai without considering how your home country or countries of residence will view this structure, you may expose yourself to double taxation, unintentional tax residency, or even legal challenges. It's very essential to coordinate with both local and international tax advisors who understand the interplay between DIFC regime and your global profile. For example, some families use DIFC to centralize assets and control distribution, while others use it in combination with other structures such as trust or offshore holding companies to ensure compliance in multiple jurisdictions. The DIFC is highly respected by global banks and tax authorities, but only if your setup is fully transparent and backed by robust documentation. Making this a core part of your family office design will help you avoid surprises and take full advantage of what Dubai has to offer. The sixth mistake that often gets overlooked is neglecting to properly budget for both initial setup and ongoing cost. The DIFC family office model is robust and internationally recognized, but it is not inexpensive. Beyond the incorporation fee, there are annual licensing costs, professional service retainers, mandatory audits, and possible regulatory filings. Some families start out with the intention to keep the cost minimal and are then surprised by the cumulative effect of professional fee, compliance, and ongoing operational requirement. Not planning for these costs can lead to underfunding the office, cutting corners, or critical compliance matters, or being forced to restructure later at a much higher expense. The right approach is to model not just your startup cost, but your annual budget for the next 3 to 5 years, including advisory, compliance, and operational expenses. This ensures that your family office is not only compliant but sustainable for long term. Seventh and the final mistake is treating the family office as a static solution rather than a living one, that is, evolving structure. Dubai's regulatory landscape is constantly updating to align with international best practices. Family needs will also change. Children grow up, asset mixes evolve, new jurisdictions become relevant. Some families set up the office and then leave it untouched, assuming their initial plan will serve them forever. In reality, a DIFC family office should be reviewed and, if needed, updated at least annually. This includes checking if the governance documents are still relevant, compliance standards are being met, and that the structure still aligns with your family goals. Failing to keep your office up to date risks failing out of regulatory compliance and missing new opportunities or being unprepared for major family or market changes. When you look at these seven mistakes together, it's clear that setting up a DIFC family office is much more than a legal procedure. It's a strategic process that requires thoughtful planning, ongoing attention, and a commitment to excellence at every stage. By avoiding these common mistakes, by avoiding all these common mistakes, you will create a foundation that is both secure and flexible for generations to come. As I mentioned earlier, if you own a business or real estate, don't wait for legal or health crisis to start thinking about protecting your wealth. Many people think asset protection is only for ultra wealthy. But the reality is that some of these solutions cost as much as setting up a free zone company in Dubai. If you want to secure what you have built and ensure your legacy, you can request your free and customized asset protection plan by clicking the link in the description below. And if you're serious about building long-term financial security, you should really check out my next video right here.